All right. Today is Tuesday, June 28th, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight, but let's start with this. We get new subscribers and viewers all the time, and of course, they have to face the scammers in the comment section, the crypto scammers who are so desperate right now because the tulip mania is imploding. So be careful out there. If the reply to your comment is not highlighted, as you can see from the screenshot right here, it's not from me. And by the way, sometimes I work from 5 in the morning all the way till midnight. I don't have the time to scam you at all, not to mention via WhatsApp. If I'm going to scam you, it's going to be a little creative. I'm going to hire a hot chick who's going to fart in a jar, that kind of stuff. So ignore, and better yet, report any scammer you see in the comment. And of course, if you're a YouTuber watching this, if you're a financial YouTuber and you have the same problem in your channel, and you think if all of us come together and talk to YouTube, that would make a difference, let me know in the comments. Because these wonderful people at YouTube, they have no problem slapping your videos with copyrights and demonetizing your video for the slightest error and the smallest violation to their so-called rules. But they're no help at all when it comes to controlling the scammers, or by the way, not just scamming folks, but ruining the experience in the comment section. But don't allow that to discourage you from participating in the comment section, because this is the only way the channel can grow and catch up in the algorithms. With that being said, I continue to read your comments, and I'm preparing a Q&A/comments video where I go over your comments and questions. And here we have some comments. Let's go over these. The viewer says, "Hey Maverick, I've been following you for quite some time, and your subscriber base has grown impressively over the past year. Thank you. Your videos are amazing and high value/quality, but I emphasize with you about how much work they are. Have you considered breaking up your videos into an in-focus day followed by a market analysis day? Basically, splitting your typical video in two and spreading your work over 2 days with videos about 20 to 30 minutes each. What I did before is splitting the videos into 2 videos per day. One is the macro analysis, the in-focus segment, and then the technical analysis. But we ran into a problem, which is cannibalization. One video eats away views from the other. Number 2, lots of confusion among viewers, so that did not work out. On top of that, now that YouTube, of course, is encouraging this stupidity of shorts, whatever that is, like if this is TikTok, leave that to TikTok. YouTube is for the pros. We produce programs, 10, 20 minutes, an hour, doesn't matter. But shorts is a bad idea. But the point being is, YouTube appreciates longer videos because they're more engaging to the audience, and that makes the program more advertisable. When you think about it, the average viewer engagement in this channel is about 30 minutes per day. Now, you might not be impressed by that, but that's a lot in YouTube lingo. Therefore, YouTube was kind of harsh on us in the beginning, but now they realize that I know how to make money, and they're choosing to embrace the channel instead. So knock on wood for now, but we'll keep the program as is. Now, there are certain segments, such as a video that I'm working on right now about the Bank of Japan versus the bond vigilantes, which I believe it's an interesting topic, but that deserves to be in a separate video in its own, a separate macro discussion. But for the most part, the videos are going to stay as is, at least for now. Here's another comment by the viewer. It reads, "Unpopular opinion, J. Powell is good at his job and Elon Musk is actually highly altruistic. I believe the Elon Musk will see about Powell, but it is possible. Don't forget, he inherited this decades-long shit show that was the Fed." Now, regarding Elon, he's going to go through important tests right now. Test number 1, what happens when Tesla stock goes back to so-called fair value? That will make him lose a lot of wealth and a lot of influence. So we'll see what he does when he becomes humbled. Is he going to change or not? Test number 2 is Twitter. For now, it appears that this is a bad deal. The numbers don't add up. He's overpaying. It's a shitty company. You gotta walk away. He has to come out and admit that he made a mistake. He spoke a little too early, and the offer is not good. Doesn't make sense at all. He's overpaying. And if Twitter is interested in a lower offer, perhaps $20 billion, $25 billion, then we're talking. But better yet, when it comes to altruistic, why not just start a new social media platform that competes with Twitter, that competes with Facebook and YouTube, but preserves the freedom of speech? He can do that. He has the money. For now, at least. But he's choosing not to do that. So I challenge your take here. Problem number 3 is the fact that he challenged the deep state oligarchy, which he's supposed to be part of. By buying Twitter, you're kind of challenging the monopoly that the deep state has over social media and public opinion. And therefore, all of a sudden, you're seeing the backlash. All of these investigations and lawsuits popping from all over the place all of a sudden, that's not a coincidence. The lesson of the day is, don't with the CIA. They run the show. They completely overtaken the government right now. And Elon Musk better realize that. Now, when it comes to Jerome Powell, he used to be a common sense kind of guy because he was against the Bernanke quantitative easing program. When he took over, his job was supposed to build on the Elon policy of normalizing the monetary policy, of increasing interest rates higher. The problem is when he did that and he announced the autopilot program back in 2018, the stock market went down by 25%. The rich, the oligarchs, the 1%, the Wall Streeters, even the president at the time got mad at Jerome Powell. What are you doing here? Why are you increasing interest rates when we don't have inflation? And of course, Jerome Powell responded by doing the 180 and the stock market recovered, but he became traumatized. He has fallen into the same trap that previous Fed chairs have fallen into, which is the obsession with the stock market. And that blindsides them, distracts them from doing their job. Their job is the economy, not the stock market. And therefore, Jerome Powell committed numerous mistakes, and that is due to his obsession with the stock market. And now we got this crazy inflation, and we're heading into a recession. So his legacy will be that he is the worst Fed chairman in history, and he cannot blame anybody else for that. His obsession with the stock market is the biggest mistake that he committed along the way. Now, here's another comment. And this is a good one. The viewer says, you mentioned that inflation will not go down on its own without the Fed going after it with more rate hikes. That makes sense to me, but I don't understand how to reconcile this with Barry's latest tweet predicting that the excess build-up supply will cause both deflation through price slashing, I guess, and a reversal of the Fed's rate hikes. Thoughts? Now, if you want to learn one thing that I've been teaching all along throughout these videos, it's this. The reason why we were upset that the Fed did not act earlier, when I say we, I mean folks like me and other economists, the likes of Larry Summers, Mohamed El-Arian, we've all been saying since last year, the Fed gotta start acting right now by normalizing the monetary policy. Start tapering now. Start increasing interest rates now. This was last year. Why? Because we don't want the Fed to let this inflation go higher, out of control, and then play catch-up. Why? Because doing so will exacerbate the possibility for a recession. What do I mean by that? The Fed tightening is one recessionary force. On its own, it's a blunt force tool, highly risky. When you combine it with other natural recessionary forces, now you have multiple headwinds attacking the economy and the stock market. You have a double whammy, a triple whammy. When you have all of these recessionary factors working on together, it becomes really hard to see how the economy will escape the inevitable path of a recession. What happened right now is inflation gotten out of control. The consumer has to allocate their budget. They can no longer spend on goods and some services because they have to spend more on gas, on rent, on groceries, on utility bills. What does that mean? It means that they're not going to spend more at Target, for example, which is running into a classic problem. Target assumed that the insane demand of 2020 and 2021 will be long-lasting, and they ordered a bunch of goods. Now that the supply chain is easing again, those goods are arriving. The problem is the demand is disappearing. Why? Once again, the consumer has to spend at the gas pump rather than buying goods from Target, and that leaves retailers such as Walmart, Target, and many of them oversupplied. That within itself is a recessionary force, because when you have a store that is oversupplied and the demand is waning, they have to slash prices. What does that mean? Their margins are going to go down. When their margins go down, they have to let go of employees and cut expenses. Now, a fallacy that a lot of folks are unfortunately falling for is, hey, look, inflation is peaking. Look at Target. It is becoming oversupplied. They're slashing prices down. So the Fed doesn't have to act by increasing interest rates anymore. Here's the problem. When you look at other corners in the economy, The demand remains too hot and the supply is nowhere to be found. This is more evident in the services sector of the economy, be it airports, be it hotels, be it even certain goods. Look at the shortage in tampons. Procter & Gamble cannot find workers anymore, even though they're paying $25 an hour because we have a labor shortage. This is unsustainable. Look at rents. They're surging out of control. Housing. And therefore, when you say that, oh, Target is becoming oversupplied, I'm not saying you, by the way, the viewer. I'm just saying whoever is saying that. That doesn't address the inflationary problem, the hyperinflationary problem in certain corners of this economy, meaning the Fed has to act using the blunt force tools to reduce demand in other corners in the economy. But again, the Fed's tools of increasing interest rates are not surgical tools. They're blunt force kind of tools. They reduce demand across all corners of the economy. So now you have multiple recessionary forces working together. The Fed increasing interest rates, and oh, by the way, certain stores are becoming oversupplied and they have to slash prices down. They have to eat a loss. They have to let go of employees. You put two and two together, you have all of these recessionary forces working together, and it's not hard to arrive to the conclusion that this economy will face a recession 100%. Now look at Jerome Powell. He's like, did I do this? Is this recession because of me? Yep, that's your problem. Another recessionary force that is working along with the Fed blunt force tools and the oversupply problem in certain retailers is the fact that we're already seeing recession hitting certain demographics in the economy. It is hitting the poor and the middle class. This inflation is becoming a recession for the poor and the middle class. No surprise here. Look at the poor and the lower mid class, for example. These two segments are already in a recession, evident with the results from Walmart and Ross. All of them are saying the demand just disappeared. The demand is gone. All of a sudden, we're all oversupplied. Why? Because the poor and the lower middle class, they cannot afford to spend at Ross or Target. They have to spend more at the gas pump to pay more for rent, etc., etc. And that recessionary force is moving higher. Soon enough, it's going to hit the mid-class. They're going to start canceling trips in the summer because they have to pay more on other things that are perhaps necessary. And then you have the high mid-class, the tech workers. When these stocks go down, these companies will have to let go of employees. So the recessionary force work its way higher all the way to the mid-class. Then you got the rich, who are dependent on what? They're dependent on the stock market, the real estate market. Well, if the Fed is going to increase interest rates higher, those are going to go down. And then the rich is not going to spend in the economy. That becomes a recessionary force. And lastly, you have the 1%, the oligarchs. Those are going to get hit the last. But the problem is, after they get hit, the government tells us that these folks are too big to fail, and we actually end up bailing them out. But rest assured, if all of this recession talk scared you away, the LA Times says, yes, a recession looks inevitable, but it may not be that bad. Here's why. You're going to lose your job. You stayed home. You might lose your home. But on the other hand, you get to go out more often now. You get to actually make friends and live life. Anyways, folks, we're not going to have an In Focus segment tonight because we already did one earlier in the day. Go ahead and check out that video. I actually enjoyed making that video. It was good because you have all of these politicians talking about inflation. You got the Fed chairman right in front of you. Nobody said, hey, Mr. Powell, do you have anything to say about your mistake of saying that inflation is transitory? And you're not going to think about thinking about raising interest rates or tapering? What do you got to say now? How the hell are you still employed at your job? Isn't inflation your fault, Mr. Powell? Isn't the subsequent recession your fault too? What do you got to say about that, Mr. Powell? Nobody said any of that. Nobody asked any of these questions. They played politics. I sponsored this bill to solve inflation. This is Biden's fault. This is the corporate greed fault. It was an absolute circus, so make sure that you watch that video. Now, with that out of the way, let's move on and cover the stock market for you. We start with the performance of indices today, and here we go. The Dow Industrial Average was down by 491.27 points, or a decline of 1.56%. The Nasdaq down by 343.1 points, or a decline of 2.98%. The S&P 500 down by 78.56 points, or a decline of 2.1%. Is it over? The bear market rally? Are we done here? We got a couple of days worth of rally. Is it over? Well, we have to look for more indicators, this time around using the heat map, most importantly, the charts analysis. But for now, we're moving on to the sector's performances today. All in the red, shame on all of them, with the exception of energy, closing up at number 1, capturing the gold, the silver, and the bronze metals. Meanwhile, the laggards of the day were led by cyclicals, technology, and communication services. The advance to decline ratios, NYSE 22% advancing versus 74% declining. The NASDAQ 22% advancing versus 73% declining. Apparently, the good breath did not last for too long. Perhaps the market needs to use Colgate. Anyhow, moving on to the commodities, what's going on here? Futures. Crude oil is saying rumors about my death are whatever that saying goes, because crude finished up higher. Both the WTI and Brent gained over 2% today. On the other hand, we have declines for gasoline. The RBOB is down by about 1.5%. Likewise, heating oil down big by a little over 3%, but mind you, heating oil is way elevated for now. And then we have natural gas with a rebound about 1.5%. Let's talk some energy news here, because yesterday we have the G7 going on in Germany, I believe, and French President Macron slipped and he admitted to President Biden that the UAE and the Saudis told him they cannot increase the oil output at all. Matter of fact, the Saudis told Macron that they can only do about 150,000 barrels per day extra. That's it. Well, that's not going to cut it. So the begging tour that Joe Biden is about to do in Saudi Arabia, he's going to walk away with a lousy 150,000 barrels per day. That's it. That's not going to cut it, and therefore crude futures are moving higher. Now, rest assured, if you happen to live in my state, the state of California, you don't have to worry about the gas pump, because we got Governor Kim Jong-un Newsom, who's going to hand away about $1,000 each for everyone. Everybody gets money. You know why? Because to relieve us from this inflation, Newsom says we need more inflation. And we know that $1,000 is going to go into spending at restaurants and bars. They're not really going to spend it on the gas pump, and that's going to stimulate more and more inflation. And by the way, Kim Jong-un is actually giving $1,000, $750 to folks making up to $250,000 a year. What's going on here? Is this really about relieving the pain at the pump? Or is this bribery ahead of the November elections? Something to think about. And here we have the big short, Michael Burry, who's understandably upset about all of this. He says, this is not how this works. That is not how any of this works. California tax rebate. What to know about inflation relief payments? Well, they're going to produce more inflation, that's for sure. What about natural gas? Well, apparently, when it rains, it pours. You want bad news? Here's some bad news for you. Natural gas used in homes may contain hazardous air pollutants that, by the way, may cause cancer. So there you go. Back to the futures. What about softs? We have OJ leading the gains with about 3.5% gains. And then we have sugar closing the day with a little over 1%. But besides that, muted activities for lumber, cocoa, on cotton futures. Watch out for cotton futures, down almost 30% in less than 3 weeks. Now, usually, in an inflationary period, we don't see commodities dropping like this because supply all of a sudden caught up with the demand. We see such drops because the speculators take profits. They cause a crash. Why would the speculators take profits? The answer is the upcoming recession. So folks who say that commodities are going down, look at copper, for example. That means inflation is waning down and no need for Fed rate hikes, and therefore the stock market is going to recover higher. That's a fantasy. Copper is coming down because recession is around the corner. The decliner in softs was coffee down by a little over 1.75% today. Here it is, metals down across the board, led by silver down almost 2%, but muted activities for palladium and platinum, both closing in the green. Now we have these sanctions, not really sanctions, but the ban on Russian gold by Europeans and North American countries. Russia happens to be one of the largest producer of gold. So would this dynamic cause gold prices to move higher? That is the assumption for now. But the dollar has to cool down. For now, the dollar is not showing any signs of cooling down. But if the dollar cools down, we see a shortage of supply of gold because of the ban on Russia, we will see the same dynamic that we've seen in natural gas, in oil, happening in gold. Gold will shoot up higher. no doubt about it. But before that happens, the dollar has to go down. What about meats? Down across the board, led by feeder cattle futures, losing almost 1.5%. Then we have lean hogs, down by about 1%. Live cattle futures, down modestly. What about grains? Green across the board, a rebound day for grains. Soybeans, soybean meal, soybean oil, corn, wheat, rough rice, all closing in the green. Yet we have declines by canola, down a little over 1%, and then muted activities for oats. Grains went down big. No doubt about it. Look at the chart of corn, for example. But here's the catch. Commodities, in this case grains, went down due to expectations of an upcoming recession. If the Fed doesn't walk the walk, meaning if the Fed says, oh, look at corn commodities, look at natural gas, it's down big from the top. Look at cotton. We don't have to walk the walk and increase interest rates higher. Watch how fast all of these commodities will rebound higher again. This is the market's way to say, Mr. Powell, we're paving the way for you to walk the walk and increase interest rates even further. But unfortunately, we have a lot of misinformation floating around saying that corn futures are down, cotton futures are down, inflation is waning down. That's not how it works. In a late cycle, when inflation actually goes down, it goes down due to a recessionary force. Moving on to the big casino, the options market. What's going on here? The hottest table is Apple with about 1 million contracts. About 48% of those were calls. Notice the contrast between puts and calls. Last week, we saw the call volume improving. We got to the 60s, even the 70s in certain names. Now we're going down and puts are actually outweighing calls. At number 2, Amazon at around 1 million contracts. About 58% of those were calls. At number 3, Tesla, the souffle, at around 1 million contracts. About 53% of those were calls. Traders are buying puts once again. This is not a good sign for the continuation of the so-called bear market rally. What about the unusual activities that took place in the options market today? We start with the ticker QCOM. This is for Qualcomm. We got news today. We're going to cover it in the heat map analysis. Positive news for Qualcomm, and therefore the stock shot up higher, and somebody's bidding for more gains to come. They bought the 150 calls for the expiration date, September 16th, with expectations that Qualcomm could move higher by more than 14% by then. They paid around $4.25 a piece to enter this trade, all in all spending around $9.5 million. What about the trade for the ticker BA? Boeing, the flying coffin. They're buying calls, interesting. The 150 calls this time around, perhaps on China optimism, I don't know. And this is for the expiration date of July 8th. With expectations that Boeing could move higher by more than 8% by then. They paid around $1.25 a piece to enter this trade, all in all spending around $1 million. What about the ticker QQQ, the NASDAQ, the Qs? They're buying puts, fading the rip. What rip, right? Anyways, they bought the 240 puts for the expiration date, July 29, with expectations that the name could move down by more than 15% by then. They paid around $1.40 a piece to enter this trade, all in all spending around $1 million. What about the trade for the ticker EXPE, Expedia? Travel names outperformed today, but mostly Chinese-related names. Somebody's buying the dip anyways by buying calls. This time around the 120 calls with expiration date August 19th, with expectations that Expedia could move higher by more than 22.5% by then. They paid around $2.50 a piece to enter this trade, all in all spending around $1.5 million. At the bottom of the table, what about the ticker CVNA, Carvana? Down big today, but this name swings in massive ways, both up and down. Now, if you're going to buy call options in the long run, betting on the weekly chart that we covered a couple of videos ago, you got to make sure that you have a longer expiration date. But if you're trading this up and down, pull up the 3 minutes or perhaps the 5 minutes chart, watch the RSI. When it gets overbought, you dump your calls, you switch to puts. When it gets oversold, you dump your puts and switch to calls. And this has been working phenomenally for the last few weeks. There's a lot of money to be made here. And of course, for the pros, you can use credit spreads. In any case, for this trade, somebody's betting for a rebound in Carvana by buying the 27.5 calls with expiration date July 8 with expectations. The name could move higher by more than 11% by then. They paid around $1.30 a piece to enter this trade, all in all spending around $700,000. Continuing with interesting trades, what about the ticker SPY, the S&P 500? They're buying puts here, the 358 puts for the expiration date, July 20th, with expectations that the SPY could go down by more than 6% by then. They paid around $2.80 apiece to enter this trade, all in all spending around $1.4 million. And lastly, what about the ticker XHB? We have a put spread here, but mind you, if you're going to follow this, the spread is really wide when we talk about the premiums. But the bet is the XHB Home Builders ETF will go down. It rebounded higher in the last few days, but honestly, it appears that that was a technical rebound, because the fundamentals say home builders should go down even more. But perhaps the XHB moved higher after Lennar's earnings, and that's already fading away. In this case, the trader bought the $50 puts, and they sold the 45 puts, all for the expiration date August 19th. They paid around $2.85 a piece for buying the $50 puts, and they received about $2.30 a piece in credit from selling the 45 puts. All in all, the entry cost is reduced to 55 cents a piece, and that brings up the total to about $250,000. The bottom line is, if the 10-year yield continues to move higher, the mortgage rates will move higher, and this is not going to be good for home builders. Moving on, the heat map analysis, what's going on here? Look at what happened. Everything is in the red with exception of energy. So all of that migration last week from energy and materials all the way to technology, communication services, cyclicals, that already faded away immediately this week. A lot of pies are being served here. Folks, both the rotation from energy and commodities all the way to the communication services, technology, software, cyclicals last week. This week, they're waking up with massive pies in the face, and the folks who shorted energy are eating a pie right now, assuming they did not close. But there is a catch. Are you going to buy the rebound in energy? That might be another pie factory, because what if this is a market reaction that we're seeing right now due to an upcoming recession? Then energy stocks are not going to do any good either. For now, can you trust anything on this map? Can you buy anything on this map? Very few names. The list is shrinking by the day. This is what happens when we get to the end of the cycle. We'll see what happens, but this is not a good reaction by the market. This is not saying all clear, risk on, none of that. We're not seeing any sustainable rally, any sustainable bear market rally. We know it's a bear market rally, but we're not even getting the usual 5% plus rally. We're not getting the usual double digits rally that we've seen back in the bear market in the aftermath of the dot-com bubble or in the aftermath of the GFC. But here's some corporate news for you. Maybe we can find some names here. The news about Qualcomm is the fact that Apple, this is a rumor for now, so watch out here. You can buy Qualcomm based on this rumor that Apple is going to use their modems, and then Apple comes out a few days from now, says, we're not doing any of that. And then Qualcomm stock goes down again. There's a lot of pumping here going on. A lot of folks stuck. Perhaps they bought call options. They want to pump these stocks at any cost possible. Who's to know that this is not fake news? Just like the fake news that we got yesterday about Robinhood. We got the news that Sam Bankman-Fried, whatever his name is, I like Fried, is looking to buy Robinhood. The stock shot up higher. And then after the bell, Sam Bankman-Fried comes out and says that I don't know what you're talking about. Nobody's buying Robinhood here. And then Robinhood goes down. So be careful of these pumps based on fake news. Now let's talk about Netflix, because Netflix is struggling. This is not a surprise to anybody who's been following this company. They're losing subscribers. On top of that, the competition is heating up significantly. And the genius idea from Sarandis this time around is to bring ads to the platform. You know what this is going to do? This is going to cannibalize on existing subscribers. A lot of folks are going to say, you know what? Why pay for Netflix when I can watch a bunch of ads? Or perhaps figure out a way to skip those ads. Ad blockers, they're going to figure that out. This is a bad move by the company. It shows that they're desperate. They're out of ideas. Then what about the EV lunacy? We have news from Cadillac this time around. They have an EV that will cost $300,000. Wow. Who's going to afford a $300,000 vehicle that, by the way, you're going to crash on your way out of the dealership? But they say, hey, you're upset about gas prices moving higher? Get yourself an EV. You mean an EV that costs $300,000? And it's a Cadillac, meaning it's garbage. You slam the door a little too hard, the entire car falls apart. But it gets even better. Toyota, which is known as the king of reliability, is now saying that the first mass-produced EV less than 2 months ago is being recalled. We got a problem here. So there you go. You're upset about gas prices, get yourself an EV, which is going to cost you an arm and a leg. And oh, by the way, the reliability is an issue. And therefore, we got Senator Manchin who says no more EV tax credit. no more bonuses for buying an EV. That's gone now. He's not going to funnel any more taxpayer money to EV manufacturers, but he's going to funnel more taxpayer money to the coal industry because every hoe got a pimp. And lastly, what about defense stocks, in this case Lockheed? I mentioned before that I'm reducing all of my long portfolio down to 5 stocks. One of these stocks is Lockheed Martin. Why? Because these war criminals actually run the administration right now, and they're set. We're talking about billions of dollars. What recession? It's not going to happen in Lockheed. We're getting Europeans spending more in defense. Matter of fact, Germany is now looking for the F-35, which they're going to get in 2026. That is a contract worth multi-billions of dollars. On top of that, NATO was meeting today or yesterday. They announced increasing spending by $350 billion. Where do you think that money will go? In the pockets of Lockheed, because Lockheed runs the government right now. So we want to stick with these kind of corporations. On top of that, we now have the hypersonic race, which for now it seems that Russia and China are ahead of the United States because every time we develop a hypersonic missile, it blows up. It's not working for us for now. Keyword for now. They're going to figure it out, but in the meantime, let's say Lockheed actually develops a hypersonic missile, a reliable one, tested, proven. They're not going to sell that to foreign governments. This will be an exclusive contract with the U.S. government, with the Pentagon. $20 billion, $30 billion, whatever the contract is. But if Lockheed instead develops defense systems against hypersonic missiles. Now we can sell these defense systems across the globe. We can scare the Europeans, shake them down for more cash. Hey, the Russians got hypersonic missiles. You want to defend your ass from that? Pay us $5 billion here, $7 billion there, and all of that money will go in the pockets of Lockheed. So I'm sticking with LMT for now. Moving on to the heat map for the ETFs. Red across the board with exception of the inverse indices, the VIX proxies. Commodities rebounding higher today. We're talking about natural gas, the ticker BOIL, B-O-I-L, UNG, on top of crude, of course. Crude oil, we have USO moving higher, energy ETFs, XOP, XLE, OIH, all outperforming. But besides that, down across the board, the contrast between value and growth, both down, but values outperforming growth. Again, is this all there is in the bear market rally? Because that's pathetic. And the other thing, are we seeing the comeback of the energy/commodities trade? I'm not buying it for now. I gotta see more. I gotta see more confirmation before I hop in. Perhaps the charts analysis can show us a little more, so let's do that. We start with the SPY, the S&P 500 30 minutes chart. Initially, we had a gap higher, believe it or not, and the chart traded above 389.82, which was resistance, became support, but that was lost right away. Not only that, but the SPY lost 385 as support. It was a massive flush down from the get-go all the way till the closing bell. Really painful for the bulls, really painful for the dip buyers. The good news for the dip buyers and the longs is look at the RSI. It is about to get oversold. We're not there yet on the 30 minutes, meaning we could go down. We could close the gap. Matter of fact, we could go down to the next support at around 373.5 before the 30 minutes chart becomes really oversold. But did the action today provide us with trading opportunities? The answer is yes. All what we have to do is zoom in to a 5 minutes chart. Look at what happened here. You got the retest in the morning right away to the gap support of 389.82. We got a little rebound, but immediately the chart failed that support line. That was warning signal number 1, aka shorting signal number 1. Then you got the confirmation, the rejection. The chart attempted to climb that line again and it failed. So that was the confirmation that we have a shorting signal. And then the chart went down all the way below 385 and it moved its way higher. In a retest, can it climb above 385 by the end of the day? Well, as I'm highlighting, we got another rejection candle. That was shorting signal number 2. Moving on to the daily chart of the continuous contract of the SPY, the S&P 500. Any good news for the bulls here? Well, the only good news is the MACD indicator remains showing positive momentum. But mind you, the MACD indicator is a lagging indicator. What does that mean? The volume went higher. The chart failed to get above 3,960 as support. The chart lost 3,855 as support. So the bears have 2 points. Losing the support. Number 2, the volume went higher. The bulls have 1 point, and that point is a lagging indicator. So who has the better argument here? The answer is clear. The bears. The Qs, 30 minutes chart. What's going on here? We got the gap higher. Similar story with SPY. and then the flush down all the way till the end of the day, and the chart lost 285 as support. Bad news for the bulls, bad news for the dip buyers. But the good news is we have another gap to fill at around 276. That is so close to the support that I got at 274.65. So why not wait till 274.65 in case the chart goes all the way down there? And if it does, it will become oversold, at least from a 30 minutes perspective. What does that mean? A rebound. Whether that rebound lasts or not, that's a different story, but you can at least play a rebound, and that would be easy looking at these technical indicators. Could we have a rebound before we go down to 274.65? Yes, it is possible, but the chart has to climb 285 and close above 285 by tomorrow. Here's the daily chart for the continuous contract for the Qs. Who has the better argument here? Because the chart did not breach below the support of 11,689, at least for now, at the time of recording of this video. The lagging indicator of the MACD still shows positive momentum. That is a point for the bulls. But the bears have the volume moving higher. So this is neutral, at least for now. Maybe the bears have slightly a better argument because you look at the chart, we have a topping candle followed by a confirmation candle. So who's to say that the support of 11,689 will be lost for good by tomorrow? If that is the case, then the bears have 2 points, the volume and the breakage of the support line, while the bulls continue to hang on the MACD indicator. The IWM, what's going on here? Small caps. We got the gap higher. It did not even reach filling the gap above at around 178.60. It reversed right away and it lost 174.22 as support. Now we have a gap below if we see more downside, but that gap is so close to the support of 168.90, so we're just going to stick to 168.90. Now, who has the better argument here from a 30 minutes perspective, the bulls or the bears? For the IWM, the bulls would argue no damage done here. We're still within the same range. The chart is still trading within a range. It did not lose an important support such as 168.90. The bears would counter and say, but why the loss in momentum? Because this chart was set up to move higher. Why the reversal that we got today? And perhaps the key to that answer is the next chart, the dollar, the DXY. The dollar moved higher today. Perhaps now it is becoming clear that maybe the cup and handle formation is playing out. And if it does, the dollar will shoot up higher, much higher. And that will be bad news for the equities market and bad news for the next chart of gold. Here is gold. For now, holding on, not doing anything at all. Gold is waiting and waiting and waiting for the dollar. One tailwind that we have right now is the ban on Russian gold. But the massive headwind remains the elevated value of the US dollar. Which one will be supreme? We will find out, but I'm not going to bet on the tailwind. I'm not going to say the ban on Russian gold will outweigh the headwind of a higher US dollar. At least not for now. Moving on to crude, Brent, what's going on here? 4 hours perspective. We got the reverse head and shoulder formation playing out. The chart got above 114. Not only that, it shot up all the way higher to 118. It is battling that level right now as resistance. Is it going to break above right away in one shot? I doubt it. I think we need a pullback, just a tiny one, for a few hours or so. And if the buyers step in again, we will see crude moving higher, cracking above 118 and eyeing 124 as resistance once again. And if that is the case, then all of this talk that we got last week about peak inflation and crude going down, hence the Fed doesn't have to tighten, which means stocks go higher again, all of that was just garbage. Absolute garbage. Trash. Here's the daily chart for the 10-year yield. What's going on here? The chart bounced from the support of 3%. It is now facing the resistance of the reversal candle at around 3.28. Here's the problem. If the chart pops higher and it starts trading above 3.28, then in all likelihood, using the probabilities here, the odds say sooner or later this chart will break above 3.5% once again. It didn't make it in one shot. It pulled down all the way to 3%, but now the chart is recharged and ready to crack above 3.5%. We'll see. But again, if this chart cracks above 3.5%, will that be good news for the equities market? Of course not, because it will signal the need of more Fed rate hikes. But perhaps a more accurate chart will be the 2-year yield. So keep an eye on that too. Here's the TLT, a weekly chart. What's going on here? Doesn't look good so far. But so long as the chart is holding above 109.5 as support, the hope is still alive. The MACD indicator is way oversold. So is the RSI. The technical signals are ready and able to produce a massive rebound rally. But the fundamentals are preventing that from happening. What about the VIX 4 hours chart? What's going on here? We got a reversal, at least for now. Why? Because number one, the chart recaptured 27.77 as support. Number two, both the RSI and the MACD indicators are reversing negative divergences. Matter of fact, the MACD indicator, which is the lagging one, is showing a tiny green impression on the histogram from a 4 hours perspective. We need a confirmation. That could happen as soon as tomorrow. If that happens, then the bear market rally in the SPY is done. Another way to look at this chart is, if we clean it up, what if this is a giant bull flag formation? And it's going to play out to the upside, and we will see the VIX passing the previous highs at around 36. The VXN, the VIX for the NASDAQ, 4 hours chart, we don't have any confirmation here about any change in the momentum. Matter of fact, the momentum remains bearish, at least according to the MACD indicator, but mind you, it is a lagging indicator. For now, we have a rebound very close from the support of the gap at around 32.72. If that holds, the next destination will be retesting the resistance at around 40. If the chart cracks above that, oh boy, we will see a massive rally in the VXN and a massive flush down in the Qs. And perhaps a leading indicator for the misery that is about to come for the NASDAQ is the daily chart for Apple, the king of the NASDAQ. Number one, the chart failed to crack above the resistance from closing the gap. It closed the gap, but it did not manage to crack above it. Number two, the chart lost the support of 138.79. Number three, the candlestick pattern shows us a reversal candle with the confirmation. So this is bad news for Apple. And if it is bad news for Apple, it will be bad news for the NASDAQ. Another giant NASDAQ name is Tesla. What's going on here from a 30 minutes perspective? A big reversal right away, and the chart is now down below 700. So we have a confirmation that this is not working out. Lots of pies being served in Tesla, at least today. If that is the case, then the next destination will be closing the gap. And this whole rally, this whole pop, the Tesla whale pop, will be gone. Now, how do you spot trading opportunities such as the reversal that we got today in Tesla? Here it is. Right away, we got the pop in the morning, a green candle, but that was followed right away in the next 30 minutes by a reversal candle. And that reversal candle was followed by a confirmation candle. This is all you need to know that Tesla's going down, and the destination was 700. So you got to trade at least from 740 all the way down to 700. Now, if you missed on that, you might want to wait for a possibility of a rebound because the 30 minutes chart, the RSI is getting a little oversold. We could see a rebound from 700, this point right here. But if we have a reversal and a crossing below 700 once again after a rebound, that will be the confirmation that you should double down. And here's your shorting opportunity all the way till closing the gap at around 650. Lastly, what about tulips, BTC? What's going on here? Not looking good. It appears that the bear flag will play out, but for now, the support of 20,000, my chart says 19,500. That support remains intact, at least for now. The problem with BTC is the following. Yes, we have bullish momentum. Look at the MACD indicator. But that bullish momentum resulted in only a lousy rebound to capture 20,000 as support. No rally, no follow-up at all. What does that mean? If the chart is going to act like this under bullish momentum in the MACD indicator, not being able to pop higher, then the forces of power are on the side of the bearish momentum. Meaning, if we have a confirmation by the MACD indicator showing us red impressions in the histogram, the bearish momentum will play out and the bearish momentum will be forceful. Big flush down candles, the support of 20,000 will be lost for sure. The point being here is the buyers better show up immediately. Otherwise, this chart will go down. It will go down big. Lastly, moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have more information on the GDP. We also have the big dog, Chairman Jerome Powell, along with ECB President Lagarde and the Bank of England, Andrew Bailey. The entire cabal of central banking will be together tomorrow. Perhaps some satanic rituals going on. Who knows? But this will be the #1 event to watch tomorrow. Lots of statements will fly out, and they will have impacts on the equities market, no doubt about it. But domestically, we have Cleveland Fed zombie, Mr. speaking, and we have another zombie from St. Louis, James Bullard, also giving remarks. With that, folks, this is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.